Welcome. I'm Ernie Goss, research economist with AIM, that's Applied Information Management of Kansas City, here today to report on Q4 results for the state of Missouri. That's for the state of Missouri. This is the workforce index. This is AIM's workforce index, and it's calculated by dividing the number of online job openings by the number of unemployed in the state. So the higher the number, the better. As the ratio goes from 0, which of course is not even possible, but that's the range, 0 to 100, which is also not very likely, that you get somewhere in between, and that's of course where you want to be. Above 50 is where you'd like to be. So that's what we're shooting for here to report the second Tuesday of the month for the Q4. I'm going to compare the Q4 numbers to Q3 numbers and talk about Missouri. Well, for Missouri advanced, the number advanced from 50.1, which is not that good for Q3, to 53.9 for Q4. Now that's a pretty good improvement. Now it may not sound like a lot, but that's getting moving in the right direction. Ranking, Missouri moved from 32nd to 28th best in the nation. Number 1, of course, is the best, and number 50 would be the worst among the 50 states. Online jobs market strengthening, that would be how I would characterize the Missouri labor market. Online jobs, where are they most plentiful? Management, number 1 in Missouri. Number 2 is sales. Number 3 is customer services. Now when you divide the number of online job openings by the current number of employed, so that percent. So relative to the market that's there, where did you have the most job openings, online job openings for Missouri for the quarter? That's Q4. Finance, engineering, that's good. Engineering, that drives a lot of other jobs, of course, and customer services. So those are the 3 best. Now here I'll be showing you the chart where Missouri's numbers, as you see, from Q3 to Q4, it improved, and the ranking came down, which is a good move, as I said, to 28th best in the nation. Like to have Missouri down there in the top 10. It's just not there right now. It's moving in that direction, but it's got a good bit of room to move there on that. The top states in America, North Dakota, but that's going to change, as you know. Their unemployment is going up in North Dakota, but it's still it's good there. Number 2, Minnesota. Number 3, Nebraska. Number 4, Kansas. And finally, Delaware, rounding out the top 5. Now, the bottom 5, they've been much the same as we've been reporting monthly numbers and the quarterly numbers. Maine, number 50. And, of course, there's some real issues in the Maine economy. Number 49, California. Number 48, Alaska. Number 47, New York. And finally, 46 is Mississippi. What should you watch out for in addition to working on looking at our workforce index, the Case-Shiller Home Price Index? Now, why watch that? Why keep an eye on it? Because it's been coming down. The year-over-year housing price growth is coming down, and that causes legislators, that's Congress and the Senate and the President, to try to do something. And now, when they start doing something for housing, it's always late and wrong, in my judgment. And what have they done recently? Reduce the down payment for first-time home buyers. Not what we want to do. That's what got us in trouble the last time. It will get us in trouble again. Keep an eye on and look at jobs added. Now that's the monthly jobs report, which comes out usually the first Friday of every month, and we'll see what's in there in terms of jobs. It's been above 200,000. Of course, the problem is it's low-wage jobs, and it's also these are a lot of part-time jobs. But look underneath. Don't just look at the headline number. Look underneath at the wage growth. It's got to strengthen, and when it does, the Fed's going to be raising rates. It's been at below 2% growth year over year. If it moves closer to 3, and it's going to take a while to get there, then the Fed will be raising rates as it moves upward. So dig in there. Look at the 10-year yield, and I talk a lot about that. It's a measure of risk. It's as I've said, the healthiest horse in the glue factory is everything else goes to in a handbasket. You know what happens. Poor investors globally come in and buy our bonds. As weak as they are, as bad as they are, they're lending at 1.6%. Now that's absurd. 1.6% for 10 years. I'm not there. I'm not buying the bonds. But I've lost some money by not buying the bonds so far. Keep an eye on what's going on in Greece and Russia, or actually what the Russians are doing outside of Russia. That would be in the Ukraine and even in other places. That raises risk, hurts trade. What's going on in Greece, they had an election about January the 25th. Not, in my judgment, not a good election. Elected the big spenders, and they're spending again, and they're threatening to spend even more. And the yield on their bonds, the sovereign bonds, went up by 2% within a couple of days of that win for the liberal spenders in Greece. So watch out for that situation. And the risk factors, as I've said, the housing market is still a risk factor. Energy and agriculture, very significant risk there with the value of the dollar. So keep an eye on that value of the dollar. As it rises, it pushes down energy prices. Of course, that's good for us consumers, but not good for that industry as they buy less steel and they buy less of other products, and that investment comes down for energy. But also we've had announcements of layoffs for John Deere already. We'll see even more because the agriculture sector is weakening because of the value of the dollar strengthening, and that's going to continue. I don't see much room for any type of real, what I'd call improvement there for the ag and energy, at least in the short run. So that's our report for Q4 and comparing it to Q3 numbers. From Missouri, I'm Ernie Goss with Applied Information Management here in Kansas City, reporting again for Q4 economic results. Until we meet again here, may your economic cup runneth over, and thanks for joining us.